Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for joining me. Today I want to talk about the activity in the stock markets and the bond markets for that matter. Right now, this is as of Wednesday, June 5th, early afternoon. The S&P 500 is off approximately 4.4% from its most recent high. Now, most technical analysts have been looking for the 4 to 5% range of a correction to hold as a symbol and a sign that we are going to go much higher. Some are now talking 1,700 or higher. So we're at a critical junction. At 1616, we're down 4.4, as I said before. And if we do not hold this level, then we could drop down to 1575 rather quickly and begin to significantly erode the gains that have been made since the beginning of the year, at least in some positions. So we're in that cusp of sell in May and go away, which is early June. I have been saying to you for some time that I was looking for a correction. I couldn't tell you then, and I can't tell you now whether this is it, but we're at a test point on the downside at 4.4%. If we were to break through 5% down, say sometime today or early tomorrow, then we're in a situation that we could be in for a significant correction, maybe as much as 10 points, which would take us to about 1,500 on the S&P 500. Which is a pretty significant support area. So we'll just have to kind of watch it. 4% is a reasonable correction. There has not been a correction greater than 4% since this rally began some time ago. And so I'm very cautious. We have cash looking for opportunities to buy. Dividends still look secure. So I'm not so much concerned about cash flow. We've had some very, very significant appreciation in some of our stocks. Some of that's eroding a little bit, but they've come a long way. Mankind in a very short period of time was up 45%. We expect to have the results of their phase 3 trial sometime in August. Every indication is that it's going to be favorable. Gilead has announced a new drug to deal with certain types of leukemia. That's in phase 1 trial. It's selling off a little bit, maybe off about 10% from its all-time high. At this level, might be a buyer of adding more to the position because I think the target of 75 or higher is still a reasonable target for the next 12 months. I think what you're going to see is some people who have seen some significant recovery in their portfolio are going to take some money off the table. They're going to put it in cash and obviously earn nothing. Waiting for the correction to go significantly lower where they're going to buy back in. I'm not sure that the market in my 40 years of experience has ever been that accommodating, but maybe this is going to be the time. I know of one person several months ago who sold all of his positions, went to cash at virtually nothing, and missed the majority of this upswing in the market. Whether he or she would have been smart enough to get out recently instead of 3 months ago remains to be seen. Interest rates are moving because the bond market believes that the Fed is probably going to start backing off on its quantitative easing purchases of mortgage-backed securities sometime in September. I don't happen to subscribe to that philosophy. In fact, some months ago, I did a blog talking about interest rates, and I said at the time, and I still believe it, that we're not done with this interest rate cycle. The Fed has told us in no uncertain terms that under their 2 mandates, inflation and employment, inflation is well in check, unemployment is not doing well, and that they don't plan to reduce interest rates until the long-term unemployment rate drops below 6.5%. I don't know that that's possible, that we can get below 6.5%. So if the 2 mandates of the Fed are to provide protection against inflation and also at the same time try and help stimulate the economy to generate jobs, they really haven't done a very good job with this whole quantitative easing. Now, that's not to say that there wouldn't be some ramifications if the Fed started to back off, but I just don't see a rationale in my mind that would allow the Fed on an employment scenario to back off. The other thing that's significant is that we are in about the 12th year of a 16-year, on average, economic super cycle for commodities. Oil, natural gas, gold, grains, cattle, you name it. And it has been this economic super cycle that has allowed many developed nations around the world to expand their economies, put people to work, and in fact grow their economies. The Economist just recently issued a report that over the last 20 years, that the world has taken 1 billion people out of poverty, putting them to work. That capitalism does in fact work. My concern is that economic supercycle for commodities is coming to an end, and without that any pressure on inflation from the commodity side of the business, with unemployment still relatively high, there's not going to be a significant amount of pressure for jobs and employment benefit increases. I don't see that inflation is a problem, except if you've got money in the bank or money in a money market fund. Even a low rate of inflation is producing negative rates of return. So I think that the interest rates probably could go a little higher on days like today when we are at near support levels on the markets, especially the S&P 500. You'll see some flight to quality moving to bonds, and so the bond market will start to rise a little bit, but I think it's only temporarily. The critical thing is about 335 or so on the yield on the 30-year bond. We went through that a week or so ago. I've come off, but I think it could go higher the next time. If you look at a chart pattern for the yield on treasuries over the last 90 days, what you'll find is that the highs are higher than the previous highs, and the lows are higher than the previous lows, so that the general trend is up. At some point in time, if treasury yields get close to 4%, which is possible, there's going to be a lot of pressure of rotation out of stocks into treasuries at 4%, especially if the economy continues to show lackluster growth. Job numbers coming out on Friday will be important. The early indication from the ADP is that the numbers were about 35,000 short, so the market's beginning to think that the jobs numbers on Friday is not going to be a really good number. You never know. But if the bond market, if the jobs numbers are poor, the bond market probably will rally again, and the stock market may sell off. So we're at a critical point, and I wanted to get out to you. I know we had some trouble technically with videos over the last few weeks, but I think that Google has finally figured out that mess. So again, thank you for watching. If you have questions, please feel free to give me a call. And should you have friends or relatives or business associates who are looking for an alternative way to manage money, please feel free to give them my name. Thanks for watching. This is Dan Perkins.